Hi, everybody. We're going to give people just a minute here to join in, and we'll get things started shortly. All right. Hello and good morning, everybody. I want to thank each and every one of you for joining us today for our webinar on Taxman Troubles, Making Your Investments Less Taxing. Today, we will discuss strategies for tax-efficient investing that will benefit your family, your bottom line, and your retirement. We do have the Q&A feature available, so you can submit questions through that option. And if there's time at the end of the session, those questions will get addressed. You can also submit any questions to us via email at rwheeler@yoursummit.com, and I will display this email address near the end of our session today. Now, I would like to introduce our panelists that will be joining us today. Matthew Larson, an investment consultant at City National Rochdale. With over a decade of industry experience, Matthew aims to enhance outcomes for clients by advising on market insights, practice management, and portfolio construction across the state of Texas and beyond. Our next panelist, Pennie Dakis, joined City National Rochdale in 2023 with 9 years of income tax, estate, and financial planning experience. She partners with financial advisors and their clients to deliver comprehensive wealth assessment services that identify opportunities to enhance financial well-being. Also today, we have Russell Martin. Russell joined City National Rochdale in 2014 and is responsible for investment strategy implementation and monitoring of private client portfolios, as well as relationship management. And our final panelist today, Rick Wheeler, is a senior financial advisor for Summit. Rick's wealth aptitude of investments, employee benefits, and insurance spans industries, including nonprofit, industrial, real estate, and healthcare. And now I will pass it over to Mr. Larson to get us started.
Thank you very much, Matthew. I'm really excited to be here today, everybody. Before we get into all of the tax talk, the meat of what we want to talk about, did want to give you a little bit of background on who City National Rochdale is, kind of how we work with the folks over there at Summit Wealth to tackle some of these problems. So City National Rochdale, we've been around for about 35 years. Most of you have probably never heard of us, and that's by design. We only work with clients on the investment management side of the house through independently minded advisors like the folks there at Summit. We do that for a very specific reason. We understand as a money manager that our role in a client's financial life is very important, but it's not the only role. And so we want to make sure when we're managing money for an individual or a family or a small institution, that we have an independent advisory group behind that client looking at all of the facets of their wealth, whether it be retirement strategies, individual investing, real estate, whatever it might be. We only operate in that sort of relationship. Now, we do have about $62 billion under management, which may sound big, it may sound small. Part of that is that we work exclusively with clients of a certain level of assets and above. And it's not because we're snobby or we think we're better than anybody or we think we're smarter than anybody. It's really the fact that, and I'll get into this a little bit more, when you get down to what we do and how we do it, it's really done best at a certain level of assets or a certain level of investments and more. Our focus or our differentiators, the things that we do that make us, I think, different from a lot of the folks out there in the space is really revolved around this circle right here. I'm not going to touch on every single one of them, but the first thing I want to mention is that every client and advisor group that comes to us here at City National Rochdale, they are assigned to a portfolio management team. So there's individuals that you or a potential client and the advisor will get to speak with and talk with about the underlying investments in the portfolio. We've got one of those on this call today, and he's actually going to be the next one to talk. That's Mr. Russell Martin. But that group, what they do is they initiate or get that portfolio started based specifically on goals and objectives set out by our clients and their advisors. We're very goal-oriented. We're very, let's make this money do what it needs to do oriented, and that becomes our entire focus. This team doesn't just set up the portfolio. They actually are there on an ongoing basis to have discussions and make changes alongside the advisor and the end client that we're working with. Very different than a lot of the other money managers out there in the space. We spend a lot of time, because each portfolio can be customized to those goals and objectives. Also talking about risk management, depending on a client, depending on their situation, we may need to take a little bit more or a little bit less of a risk management focus, but just know that we're customized in that sense as well. And then what we're all here to talk about today, probably most importantly, would be the tax management side of it. And we're going to get into that a little bit more as we kind of get through here. I like to look at this visual right here just to give everyone a concept of kind of how we operate and how we work. Here on the left-hand side, see a light blue circle encompassing a dark blue circle. That just represents the client and advisor, in this case, Summit's relationship and how we work with them. The other two circles, we've got basically a lime and a lemon wedge and a blueberry here. If you were to draw a big circle around that, that would be City National Rochdale. And you can see in here, there's various entities, a senior investment consultant, which is my role. We do a lot of the upfront analysis on portfolios. When clients decide that they want to move forward with us, them and their advisor then meet up with the portfolio management team. They take a lot of time building that portfolio to do exactly what I said, and that's accomplish goals and objectives. The investment strategy committee over here represents all of the people in the background, really curating a very robust list of acceptable securities, things that we screen and follow on a regular basis, things that we are comfortable with clients holding. And from that list and the client's goals and objectives, we build out the custom portfolio. Right here in the chevron or arrow pointing down, this represents our private wealth solutions team. And this is a really unique group of individuals here at City National Rochdale. They focus more and more on the tax and the trust and the estate planning side of the house, but we have expertise. One of them is here today as well. That would be Pennie Dakis. And that group right there really helps with the advisor and the client on any aspect, broad-based planning, whether it be estate or tax. Usually those are combined issues. And they're here as a resource alongside everyone else at our firm. To break that group down and City National Rochdale as a whole, we want to look at these strategic pillars of wealth, or what we want to focus on when we're talking about planning, specifically taxes, estate, return and risk, so on and so forth. You see there's 5 here. We're going to spend the majority of today on income tax considerations and estate and legacy planning, but this slide's here to let you know that we handle an array of issues. With that, I wanted to kind of pass back to Rick Wheeler here from Summit for a moment.
Appreciate that, Matt. And yes, City National Rochdale has been a partner of ours for a number of years. I have quite a few clients of mine, personal clients, personal relationships that City National Rochdale comes alongside of me, and they help manage those assets. And really the key to that is because for me in particular, like many of my clients, probably all of you on this call right now, we don't want to give too much tax away, give it to those that we don't necessarily always trust to spend it on the best interest of ourselves. So this team, they're going to talk about tax alpha in just a minute, but primarily they help me integrate with my clients, not just looking at the money that they manage for us or help us manage, but they also will take a look at the whole picture, the real estate, the Roth IRAs, the CDs, the bonds. They take a holistic approach to that and can help us provide advice, just like Pennie on this call, as well as an entire team that help us deal with tax questions. There's not a charge for me to be able to call into them and say, hey, I've got someone that's got a problem here, a taxable event, or they just want to be able to avoid, sorry, my CPA friends will get very mad at me using the word avoid in taxes in the same sentence. Mitigate taxes. If that's the case, then these are the guys that you can call. And I do have them on my speed dial. I have called them from time to time to be able to address those questions. So they're going to jump into some areas here. Hopefully this is new to you and ways to do that. And the primary goal is to not just help you deal with the taxes, but also create these tax losses when it's timely to do so. And at the end of each year, not only maximize your performance by increasing the overall reward at a lower risk, they get very in-depth in their analysis, taking a look back at previous tax forms and your filings from previous years, and maybe even find a reason to refile those taxes. There's a lot of depth on this bench, and they are a great resource. We are a resource for our clients as well. And those of you on this call today, just wanted to be able to address that everything that we do, and every time we do these webinars, it is to educate and to be helpful where we can. Whether we have any type of product to include or not, that does not matter. You are our clients, and we are here to serve you. So with that said, I'm going to hand it back over to my CNR friends. I believe Russ is going to get ready to jump in here in just a moment.
Great. Thanks so much, Rick. And thanks everybody for joining us today. We're going to focus on two key areas of how we think about taxes on the remainder of the call today. I'm going to spend a few minutes here talking about how we address taxes within an investment portfolio. And then Penny's going to come on and talk about really the focus on income tax considerations, and then a little teaser on some of the things that we think about as far as estate taxes. When we use the term tax alpha, that's kind of a fancy technical term. And so what do we really mean by that? Well, this is the idea that we want to use tax saving strategies within investment portfolios to not only maximize how much money you're able to make for a given level of risk, but importantly, how much money you get to keep, or what's known as your after-tax rate of return. It's one thing to have a good balance of returns and risk in a portfolio, but it's another thing to do that in a way that really optimizes the tax treatment of how you generate that return, helping you to keep as much money as possible in your wallet and sending as minimal amount as required by law to the government for taxes. And when we think about the value proposition for investing, yes, of course, everybody hears stories of a hot stock that did particularly well, or a great investment that maybe your friend on the golf course or colleague at work told you about. But when we look holistically at managing wealth for people, as you can see in the table at the bottom of the page, the tax management component of managing assets for a client adds arguably the most value over time when we look at creating those outcomes for clients. Now at City National Rochdale, we have a unique approach to tax management, and it's a three-step process. Again, focused on maximizing those after-tax rates of return. And we do this by looking at three key steps in coordination with the client and the financial advisor, the team at Summit, and then also considering other experts that that client may have on their team, whether that's a tax preparation, a CPA, or something like that, maybe an attorney who's involved with drafting trusts or estate documents, things of that nature. And we want to make sure there's a coordinated approach as we engage in this three-step process. The first is planning and tax budgeting. The second is what we call asset location and actually implementing this in client portfolios. And the third is ongoing management of the tax budgets. And I'm going to talk a little bit about each of those three steps right now. The first, the planning component, really begins with an initial assessment and analysis of an existing portfolio or assets that a client has. And we do this in coordination with Rick and the team at Summit, where we not only want to look at what we might call investable assets, things that are maybe in stocks or bonds. Maybe this is a trust account or a joint tenant account, or maybe an IRA that you have that you've rolled over from a 401k plan from a previous employer. But this is also looking at other assets that you may own, whether it's real estate or whether there's inheritance to be considered, whether it's a business interest. We really want to take that holistic view of the entire situation. And from there, we use proprietary tools that we have in-house, our Galaxy software, as we call it, to do an assessment of how we think the piece of the puzzle that we might be entrusted with managing ought to be put to work in the most efficient way, both from a return and a risk perspective, but also from a taxation perspective. We'll then do an analysis of what it would take to transition that portfolio from where it is today to that optimal portfolio that we have done the analysis on. And we consider any potential tax consequences in making that move, primarily looking at any capital gains that might be realized. And capital gains occur when you buy something and it goes up in value and then you sell it. And this would be in any account that is not a retirement account. So a trust account, a joint tenant account, what we would call an after-tax account. And so we really want to be thoughtful about those capital gains in a portfolio transition, because many managers out there in the world, they don't have these conversations proactively with the client's financial advisor or in partnership with their CPA or tax preparation firm. They simply say, yes, thank you for hiring us. We're going to sell everything that we don't want for you on day one. We're going to buy everything that we want for you on day two. And oh, that big tax bill that you just got, well, that's your problem, not ours. We don't think that's a very good way to do business with people. And we certainly know that that's not the most intelligent way as far as creating the highest probability of success of achieving your goals by being thoughtful about managing those taxes. When we're building out portfolios, we also think about these different account types. So some clients may have IRA accounts or what are called qualified accounts. Some may have taxable accounts, these after-tax assets that they're investing. Some clients may have both. And we want to be very thoughtful about what we own in each of those accounts based on the tax treatment of the investment that we're looking at, and also the taxability of that account type. So for example, in an IRA account, we know that anything that happens inside that account does not trigger any tax consequence. So we can do things like taking capital gains or seeking higher returns from taxable bonds as opposed to municipal bonds, because we know that that tax event is not going to show up on the client's tax return every year. Those IRA accounts only become taxable to a client when they start taking withdrawals from them later in life. So we'll pick certain investments to be in those IRA accounts to maximize the return, because we know we don't have to think about the tax consequence in the near term. Additionally, in a non-qualified or an after-tax account, that's where we want to be much more thoughtful. These capital gains budgets that we've talked about here as far as the transition goes, looking at more tax efficient income generation, whether that be municipal bonds or even more tax-friendly, what are called qualified dividends that are taxed at a lower rate than what's known as ordinary income, which is taxed like the wages that you earn at work, the highest tax brackets in that regard. And so we think about these things all in coordination with one another, and we implement what we call asset location, owning certain investment types in certain accounts based on the client's overall objectives, the types of accounts they have, how much they have in each account, and the overall type of portfolio that we want to build out. Last but not least here, this is an ongoing process. This is not a one-time event that just happens at the beginning of a client relationship, but this is something where we at City National Rochdale are in communication with Rick and the team at Summit frequently with respect to what are the events going on in the client's life that we need to be aware of. Are there other tax events going on with other things that they have? Maybe it's a large equity award at work, or maybe they sold a property, or they got an inheritance, or whatever it might be. We want to make sure that we're always communicating and in the know and partnering not only with Rick and his team, but also making sure that as needed, the CPAs or the attorneys are looped in as well, so that everybody on the team can be working toward the same goal to maximize the outcomes for that client. So with that, I'll pause and we'll pass it over to Pennie Dakis to talk a little bit more on the taxation front as far as income and estate taxes.
Thanks, Russ. So I'm a member of the Private Wealth Solutions team at City National Rochdale. Our teams primarily focus on personal wealth and financial planning for clients with high net worth and ultra high net worth estates. We do this with a focus on the strategic pillars of wealth that Matthew went through earlier in this webinar, coupled with our investment management approach. Today's webinar will be covering what's new for 2024, some income tax considerations, and if there's time at the end, a teaser on some estate and legacy planning ideas. So what's new for 2024? While the Secure 2.0 Act was enacted in 2022 and brought a lot of changes around retirement-related provisions, we've highlighted a few provisions that go into effect this year, 2024, that may impact our clients. So starting off with 529 plans. Prior to this legislation, a 529 plan withdrawal for anything other than qualified education expenses would be subject to income tax and a 10% penalty. Starting this year, 529 account owners can roll over up to $35,000 from a 529 plan into a Roth IRA for the benefit of that 529 plan beneficiary. Note that this rollover is subject to the $6,500 per year rollover limit and must be in the same name as the 529 plan beneficiary, among other limitations. In addition, the 529 plan must have been in existence for at least 15 years prior to the rollover, and any 529 contributions made within the last 5 years are ineligible. I do want to note that this new legislation shouldn't emphasize the overfunding of a 529 plan. In addition to that, there's been some big changes to required minimum distributions, also known as RMDs. As of January 1, 2023, the age to start taking these required minimum distributions have increased from age 72 to age 73 and will increase to age 75 in 2033. While a small change starting in 2024, required minimum distributions will no longer be required from Roth accounts in employer retirement plans. Designated Roth accounts such as Roth 401ks or 403bs were formerly subject to these RMD rules, but no longer will be starting in 2024. This change allows your account to accumulate money to pass down to your heirs, and is a great advantage to take advantage of. Let's flip to the next slide. Contribution limit increases. Because of increased inflation brackets have gone up, clients should be maxing out these amounts that we see here. So for example, employee contribution limits in a 401k have increased to $500. Overall contributions have increased to $3,000. HSA contributions have gone up as well. Moving forward, we're expecting that these catch-up contributions will likely go up, but the amounts remain the same and have been the same for quite some time now. Now on to income tax planning. We've highlighted a few income tax considerations. So one popular consideration is a Roth conversion. A Roth conversion involves transferring retirement funds from a traditional IRA or 401k into a Roth account. So when this rollover happens, the amount of the rollover would be subject to ordinary income tax rates, and the benefit of doing something like this would be tax-free growth and tax-free withdrawals. It may make sense to do something like this in a year where income is low. Tax bracket management is important when considering a Roth conversion. So, like I mentioned earlier, when you do this type of conversion, you realize ordinary income, which in some cases may force you into a higher income tax bracket. So it's important. So another consideration would be possibly spreading the conversion over multiple years. So if it does happen to put you into a higher tax bracket, possibly implementing spreading the conversion over multiple years to lessen the tax blow and make it more manageable. In addition to that, you can also couple that conversion with a contribution to charity. So if it happens to increase your tax bracket, you may want to consider implementing some charitable distributions, which in turn may lower that tax bracket. Another option would be a G2 conversion. So if you have a child earning income that may be in a lower tax bracket, they may want to consider converting to a Roth in that year, and G1, which would be the parents, could use their annual exclusion gifts to pay the tax that would ultimately be due on that conversion. For clients that are philanthropically inclined, charitable planning could be an important way to minimize taxes. I do want to note that adjusted gross income limitations come into play when implementing these type of gifts. Donor advised funds are an option when doing larger gifts and are good for clients with higher philanthropic intent. It allows the donor greater ease of administration while still allowing them to maintain significant control over the placement and distribution of these types of gifts. A lot of clients may consider doing this in a high income year. For example, if someone may be selling their business or expecting a higher income year, funding a donor advised fund may make sense in that situation. Another option for charity is the charitable remainder trust, also referred to CRT. This type of trust is good for those that may have some philanthropic intent and may have a large capital gains tax event, or possibly have an appreciated asset that they expect to pay capital gains on. Essentially, how this type of trust works is you set up the trust, you fund it with, let's just say, some appreciated stock. And in the year of sale, that trust wouldn't recognize any capital gains. You would receive a partial tax deduction in that year, and then you would receive an income flow throughout your life from this trust that would be taxable. So essentially, you're deferring the tax that would ultimately be due on that large capital gains tax event. And then lastly, another option that sometimes comes up, a very complex strategy referred to as the net unrealized appreciation election. The NUA is the gain on an employer stock held within an employer-sponsored retirement plan. Basically, the essence of making this type of election is to make the decision of paying taxes sooner at a blend of ordinary income tax rates on the cost basis of that employee stock and capital gains tax on the unrealized gain when the shares are sold, rather than rolling it over into an IRA and deferring tax until withdrawals are taken from this IRA. Why should you care about NUA? When you want to distribute company stock or its value out of your 401k, you'll be faced with a choice. Roll it into an IRA or another 401k plan, or distribute the company stock into a taxable account and roll the remaining assets into an IRA or 401k. It really depends on your facts and circumstances here. And each person's situation is different. It's important to consider a number of factors in conjunction with your financial advisor and CPA before implementing this type of strategy. I'll pause here and turn it back over to Rick.
Appreciate that, Penny. And I know that just on the 529 plan side alone, I've had a couple of clients in particular that honestly overfunded their grandchildren's 529 plans. And that was a big bone of contention and fear as we've done such a good job. What do we do here? And both of them were extremely excited to hear that they did not waste their money. They actually were able to set aside up to $35,000 of that money, including for one that did not go to college. And that becomes the whole wedding fund, the buying the car, the eventually being able to buy a house. So there's a lot of opportunity if you're aware of these kind of things, or at least having a resource, whether it's a team like CNR or ourselves here at Summit, of just calling and asking the question. You don't have to be a client to call and ask me those questions. I'm happy to help. I'm here to educate. But one of the things I did want to highlight that on the income tax planning side, whether you're using 401k plans, Roth IRAs, traditional IRAs, regular brokerage accounts, annuities, that they all have taxable consequences, whether going into, coming out of, or maybe it's tax deferred growth within the plan. There are some very important ways that you can titrate out of those once we hit that point of freedom. That's my term for retirement. Whether you choose to keep working, the goal is, and my goal is to get you to that point of freedom so that you do feel free. Whether you choose to work and continue to have income, at least at some point, you know that I don't necessarily have to work anymore. And that is very freeing. But the problem I run into with clients that I meet with on a regular basis, I say almost every week this year, I've had a conversation with a client or somebody who I'm just helping on the side. they are struggling with the fears of going into retirement, the Social Security questions, the concerns about limited income, not having the paycheck anymore, not knowing how to navigate Medicare and the concerns of insurances, especially if you retire a bit early and you have to wait to get to Medicare. What makes the most sense? Dealing with the supplements choices. What about if something happens to me as the husband in this case? It's my big fear is what's going to happen to maybe my wife or kids and grandkids. There's a lot of questions that all of a sudden become very prevalent that you may not think about much. But as you get near retirement and as you enter retirement, I hear it again and again. It's almost a sense of panic that can set in. And being able to have strategies in place before you reach that point, or if you're already there and you need some help in kind of navigating the next few years. I tend to think of, I've mentioned, I think in previous, those that know me, my father's battle with Alzheimer's for 11 years, starting actually 4 years older than I am now when it started. And this brilliant engineer needed help. And I thank God that I was available and I had the expertise to help him. And I have a team around me here at Summit and partners like CNR to ask good questions. But being able to help my family navigate that was kind of one of the most rewarding, difficult, but rewarding years of my life, and helping address all the insurance, the long-term care, and dealing with the taxes of sale of homes and liquidation of accounts and getting everything rolled out the way my father wanted it to happen before he passed. So being able to address that well in advance, giving you the peace of mind, giving you the confidence as you enter those years, those days of freedom, is very important to us. But knowing that if you don't have a plan, there's an old saying that if you aim for nothing, you'll hit it every time. It's very tragic whenever I meet with people that are years late in starting to do that planning. And at this point, we're just doing damage control, but we're here to help with that as well. So being able to have those conversations are important. I know that for a particular client that comes to mind that I have actually provided a connection to CNR, the team that you're hearing from today, including Russ. He is the one primarily managing the assets for one of my most important, most favorite clients. But that client in particular brought a statement from his taxable account, and we're talking about a couple of $1 million, but paid about $20,000 in unnecessary taxes in the previous year. So CNR was able to show how they would invest differently. And then over the last couple of years, there was no tax liability. And what was sad was in 2022, well, what was great was that we did move the assets into this new plan. If they had left it where it was, even though the accounts were down in 2022 across the board, unless you were all the way invested in nothing but oil, you would have lost anywhere from 14 to 25% in 2022. Well, this client lost quite a bit less than that, but there was no tax liability. It was a matter of fact, by doing the tax alpha approach that they've hinted at so far, they were able to create a tax loss harvest for this client that for years to come will offset future gains. The income that they had been receiving off of their investments was around $38,000 a year. Well, that got doubled over this last year with City National Rochdale. So making sure that the approach makes sense for you is very important to me. And I won't trust just anyone with my clients' money, but being able to make sure that they are looking at every avenue, beginning to end for the next 40 years through your life and beyond, on into the next generation or to the nonprofits that you might want to support. If there's any type of legacy to be left, is very important. And that is a part of the reason that we are addressing taxable situations, because we know it's a hot topic. It's a fear, it's a concern, and it's going to continue to be a problem. With that, I'm going to hand it back over to the CNR team.
Perfect, Greg. Thank you very much. Wanted to just check in. I see that we do have some time to touch sort of high level on the estate tax side of the house. And so I think that some of this information is very relevant. I'd like to bring Pennie back on here to kind of round out our part of the conversation and just sort of hit the highlights on what people should be aware of, whether it affects them, family member, a friend. All things are relevant. So with that, Pennie, please.
Thank you. Great. So one of the other pillars that we were hoping to hit on today was estate planning, and it might not apply to everyone on this call, but it's worth mentioning. we typically take a holistic approach for each of our clients and their specific facts and circumstances. And it's important to address this. If we could flip to the next slide. So for those of you on this call, in 2026, we're expecting the great sunset. So January 1, 2026, we're expecting a lot of provisions to change. Income taxes are expected to go back up, and we're anticipating that the lifetime exemption is to go back down. So I like to start off with this. We're looking at historic and expected exemption amounts. Currently, for each spouse, that exemption amount is at 13.6. So for a married couple, we're looking at 27.2 million that could be given during life or at death. Anything above that amount would be subject to a 40% estate tax at the federal level, plus state if applicable. The 2026 amount will come down to about 7 per person, so 14 million total, which is a pretty steep drop off when the clock ticks midnight. We'll flip to the next page just to review some ideas. Just a few simple ideas that a lot of our clients take advantage of on a yearly basis. So annual gifting is a great way to gift to the next generation or individuals without using any of this lifetime exemption that I mentioned. So for tax year 2024, individuals can gift up to $18,000 per individual, or if they're married, $36,000. This can be quite impactful if coupled over several years, which we'll see on the next slide. But another item to take advantage of now are valuation discounts. So basically, this is marketability discounts on e-liquid assets. So for example, if a client has an e-liquid asset, say a business, they may want to gift it to a child or to a trust. They may be able to take advantage of anywhere from a 10% to a 30% discount depending on the valuation. So basically, that's a lesser amount that's being used of your lifetime exemption, and all of that appreciation is outside of your estate. And flip to the next page. And just a quick example on how compounding these type of strategies can be impactful. So a married couple with 3 children, they're making annual exclusion gifts each year for 20 years. So basically 36,000 times 3 over 20 years, we're looking at 2.1 million of gifted assets. If you multiply that by the estate tax rate, that's almost 900,000 additional amount to heirs. For valuation discounts, assuming a 25% discount, you'd say on a business, so that could be a total of 18.14 that could be gifted of fair market value. So $18 million gift, less that $7 million 2026 exemption, that could be an additional 11.1 million bonus appreciation going to heirs or other individuals. I'll pause here. If there's any questions, we can open up the Q&A.
Yeah, I was going to jump in here. We do have a question I was going to address, and I think it is an important one. And I think that whenever I hear estate tax, it's not my problem. I wish it was my problem. And I think many of the people that are listening today would wish that we had to worry about an estate tax situation down the road in the future. But the reality is there's no guarantees. There's no expectation that by the time things start to sunset in 2026, especially if we have good performances, doesn't, as we know, over 10, 20, 30 years, the multiplication factor of the assets. I have clients today that never expected to be millionaires by the time they hit retirement. You don't know what the future may hold. You don't know what your health may be like, and being able to have the plan in place, not just for the high end, but any end. If you have assets, there are tax approaches that we can at least have a conversation about. I work with attorneys. I met with an attorney friend yesterday, specifically for a non-high net worth client of mine that's dealing with some issues. He just retired and there's been some problems. So having the resource available, once again, we are a resource. That's our primary focus. Is what I think of. Number one, my job as an advisor is to advise. It's to be a resource to help deal with anything financial. But as we kind of wrap up this conversation today, and as I ask this question to the team here, I'll give my opinion if there's time for it, but wanted to be able to address the fact that with the sunset of these taxable decreases, and we're getting ready to have that change, and it could change 4 or 5 times by the time we hit 2030. what do we see, or what should we do about our tax deferred accounts before the sunsetting of that, before 2026? Should we start drawing down from those accounts? Should we let them ride and keep our fingers crossed so they'll extend them? What do you guys think? Maybe Russ, do you want to address that for us real quick?
Yeah, so I think, I want to really double down on something that you said earlier, Rick, which is that you and the team at Summit and us and the team at City National Rochdale, we are not product salespeople. We are not here to tell you there's a one-size-fits-all approach for everyone. And so the answer to that question for people listening to the call today, their friends, their family, it really is a unique response based on the different assets and life situation and sources of income and sources of tax liability that each of those clients have. And so there are various strategies that can be considered. Maybe it's considering whether we take some capital gains prior to the sunset hitting. Certainly for anybody with an estate tax problem, making sure you're locking in the higher exemption amounts that are available today, as opposed to after the sunset, those amounts are approximately cut in half. Maybe it's thinking about the balance that you have in a 401k or an IRA that is going to be ordinary income to you when you start taking that out, and doing some analysis with Rick and his team about potential conversions to Roth IRAs, which effectively means pay a little more tax now so that you have to pay no tax on those assets for the rest of your life. So there's various different strategies and components here that ought to be considered. And what we really want to emphasize is that the right solution, the right action plan for each of the people on the call today and the various clients that we work with in partnership with Summit, it's not a one-size-fits-all approach. It really starts with getting to know each and every client and their situation, doing a holistic view of what they have going on, and being able to really tailor that advice and guidance based on their unique and specific considerations, as opposed to trying to push the same exact strategy or product, if you will, on everybody, which unfortunately is somewhat commonplace in the financial services marketplace. So it's a different mentality, a different approach. And we really want to highlight that in working with Rick and the team at Summit and our philosophy here at City National Rochdale, it's very client-centric and not product-centric.
I love the way that you put that. I'm going to add one quick caveat before we wrap up, and then I think to highlight it, whether you work with any advisor or you work with just yourself, managing your accounts yourself, or you're working with a team alongside of an advisor like City National, there's primarily 4 Ps. I like to use it. I was a Baptist guy back in my youth, and I think whenever you use alliteration, you get brownie points in the Baptist faith. So I'm going to do that. I focus on the 4 Ps of really having an exceptional team around you. And that really is, number one is price. It's what people look at first. They want to say, what am I going to get for my money? You tend to get what you pay for, but also know that quite often these days, the price is pretty close to the same for most companies or individuals or advisors that you work with. So in honesty, it usually doesn't mean as much as the other 3. The next one is products. And like Russ just said, products are not pushing a product, they're pushing a plan, which is the 3rd P. The plan is much more important. You use products to fill some gaps in that plan in order to meet the goals, needs, wishes, wants, and strategy for a family. But the most important is really the people, and the people that you choose to trust with. Quite honestly, one of the most important things that you deal with, we all think about money quite often more than we probably should, but how important does that get, especially once you're getting into your 70s, 80s, 90s, taking care of parents, maybe taking care of your kids, college. There's so many things. We rely on money for everything. And having a team of the people, which is the most important, that you trust for the next 20 years of your life, especially during that journey through freedom after retirement, is an extremely important thing. So being able to have partners, another P, being able to focus on that as a part of this whole process, another P, I can't help myself, is very, very important for the rest of your life. So whether you've got that person in mind that you can meet with and talk through, maybe you've got a friend that you can be a sounding board on those things, feel free to include us in the conversation. Again, we don't expect to get paid on these things. We're having a conversation. If we end up helping you for more than just group benefits or life insurance or anything else, just know that we're here. And you don't have to say, hey, that's not my advisor. I'm happy to help and address questions and answer those questions for you. If there's anything that we can do. So with that, I'm going to wrap things up. I'm going to thank our team here at City National Rochdale. I appreciate you guys. I appreciate the partnership, and we appreciate our partners and clients that have made some time and given us the trust to be able to listen and maybe learn something new today. If you need anything, you feel free to send me that email, and I'm going to hand it over to my team member here at Summit, Matthew Murray. Take it away.
Well, thank you again to Matthew Larson, Pennie, Dakis, and Russell Martin, as well as Rick Wheeler for their time and sharing this informative and valuable information with us. We'd also like to thank all of you for joining today's session. If you have any questions or would like to be connected to a resource here at Summit, please email rwheeler@yoursummit.com, as we will be happy to assist. And to look ahead, mark your calendars for our next quarterly webinar, Unlock a World of Possibilities with 529 Plans, which we will look forward to holding on June 6th, 2024. As well, please be sure to join us on social media to stay up to date on market trends, legislative updates, and tips and tricks to help pursue your retirement goals. As always, thank you for joining us and helping us reach your summit.